Welcome, everybody. We would like to welcome you back to our class that we're doing for our communities in Elizabeth City and Savannah. Today, I promised to invite you back for about 15 minutes. You had lots of questions for our last class, and I wanted to take the time to answer some of those questions. And we will be sharing this information with all of those who could not attend today. So, first of all, we would like to say thank you once again to all the leaders in Savannah and Elizabeth City who got together and decided that we wanted to do some things for the community to begin to change the money mindset of our community and to make sure that everyone was financially prepared to help build generational wealth and to protect their families. We want to make sure that if anyone in your family passes away too soon, that the family can continue to go on, stay in their house, in their homes, and to make sure that you are beginning to think about what plans you need to put in place. So, a couple of the questions that we ended up with is I will go ahead and start with that first question. The first question was, what is the best type of life insurance? So, the best type of life insurance is the one that is designed specifically for you. You can, in fact, utilize both major types of life insurance. That is the whole life insurance that we talked about last week when we were together. And the whole life consists of insurance with a cash savings that is attached to it automatically. It is typically permanent and lasts your whole life. Or you can build a plan with term insurance with just insurance that's at a cheaper rate for a set amount of time. That set amount of time could be 5 years or 10 years, 15, 20, 30 years. But we can utilize both insurances, one or the other, and some accidental, critical illness, long term care to build a solution that meets your family's needs. So, which type of insurance, life insurance is the best is based on the need, the goal, and your why for your family. Okay. The next question that we had in place was if you've had cancer, are you insurable? So, the answer to that question is well, it depends upon how long it has been since you have been in remission, and it depends upon which company you go with. And you have to be open minded to the type of policy or plan that you get. Once again, we here at Waring Financial Services, we represent well over 40 companies, and therefore we have lots of types of insurances that we can put in place for you. So typically, if you have been out in remission for several years, then we are able to possibly put a plan in place for you. It is may not be the amount of coverage that you want, and it may not be everything that you need, but it definitely is a plan that we can put most likely put in place for you that could give you a beneficiary 5, 10, or 15 years worth of mortgage payments, or it could give you a beneficiary equity protection or critical period coverage. That means we can get enough coverage to keep your family in the house for the next 3 to 5 years while they try to figure out the next move. It could give them also enough coverage to maybe if they need to sell their home, so they don't lose the home during that probate period. However, yes, most likely, if you've been in remission over 2 years or three, there is a type of program that we could get you covered with. But you have to be open minded and look at it as a solution and as a plan, not just a policy, period. Because you can start with one policy and then we could do a checkup every year or 2 years or 3 years, because the longer you are in remission and the farther you are away from the cancer, you may begin to qualify for more policies. So we always do a checkup with our clientele to say, hey, let's start with this plan. This is what you're qualified for right now, but in the future you could be qualified for something more or different. Okay. So I have the next question says that I mentioned some $8 and $10 life insurance, and I needed that we needed to be careful about the type of insurance. And do you think that it will probably be enough? Well, the reason I said to be careful if you have the type of policy that costs $8 and $10 is because a lot of times that's accidental death. Accidental death is great for what the goal of that is. However, accidental death only pays off in the case of an accident. And I'm not saying that that's the only way you could have an $8 or $10 policy. If you got it when you were super young or a kid policy, or it could be fine, but you definitely need to get a policy review to see what type of policy it is and what type of coverage it is. But accidental death is, I call icing on the cake. You should also have an accidental death policy, or you could, but you need to get a policy review and make sure that it is the type of policy that you're looking for. If you want a policy that will pay, I was going to say whole life, but a policy that will pay off no matter what circumstances, then you want to make sure it's not just accidental death. But don't go canceling your accidental death if that's what you have, because any policy that you have for $8 is icing on the cake. But again, accidental death only pays off in the case of an accident. So the next question I had from you all was, what exactly is mortgage protection? So mortgage protection. This is not the type of insurance that pays the mortgage company. This is the type of insurance that pays your beneficiary either the whole amount of the mortgage or a portion, maybe three-fourths or a half. It pays that mortgage off just in case you pass away too soon before that mortgage is paid. It also protects the family, that they can stay in the home. So that you want, and is paid to your beneficiary of your choice, spouse or children, or your auntie, or whoever is going to be in charge of the home or taking care of the kids. That is a plan that everyone who owns a home should have in place. And even if you rent, you want to make sure that you have the right type of life insurance that's going to give enough rent payments until your children are grown and gone and have another plan. Okay, so mortgage protection usually is a type of term insurance that is written either for the 30 years or 20 years or 15 years that you have left on that mortgage. And we use that again so you can build plans or solutions and put them in place so that your family can be protected from losing your home. That check comes to the beneficiary. Um, the next one of the other questions I had, so I'll go ahead and answer it now, was this person said they were in their 70s and the mortgage protection insurance was too expensive. So therefore they didn't get it. So I would say, make sure you fill out our form, reach out to us, let us set an appointment with you, because you would most likely benefit from critical period equity protection plan. That way we can give you enough coverage to help for a set number of payments, maybe 3 years, 5 years, or until the house can get sold, or whatever the plan is. If your children are going to take over the home or your spouse is going to take over the home, let's talk about a solution and a plan that gives them time to make other arrangements. Give them time to either sell the home or get a tenant in the home, or gives them time to reposition their income and their finances so that they can take over the mortgage. So what you want to do is to get a mortgage protection plan in place, and we focus on getting a level term, not necessarily decrease in term. So you might want to think into that. Okay, so we're going to take on about 2 more questions. I only have about 3 more questions altogether. So the next question was about retirement and how an insurance plan can be used for retirement. That would be called an annuity. So you can use an annuity to It's a type of insurance product that can be is usually fixed. It can be variable, but typically fixed, which is a pretty safe place to put your money, especially during this season. And typically, I did have a lot of questions about rolling over old 401ks so that can be stable. So typically, a lot of people move their money if they've left their jobs or retired from their job or left a job or have some money just sitting around not earning much interest. Typically, people like to move that money into annuity because it can usually gain a pretty good interest rate, maybe for a different, percentages guaranteed based on the history of that, based on the what that fund promises. It's a good way to grow money. I did have some teachers in the audience, and they're used to 403bs. It's kind of the same concept, but it's not it doesn't have to be a qualified account. And typically 403bs are accounts that are with nonprofit organizations like schools and maybe churches and colleges, which is another type of a school. So yes, the question was, do we at Waring Financial Services have annuities? We do some great annuities. In fact, I'll be happy to sit with you personally and do a little presentation for you on the annuities. And it's a great place to put money and grow for retirement. Okay, excellent. And one more question. Someone asked, how do you protect your income? Because I spoke on that. So I did talk about that. That would be some type of disability product or a critical illness product. If you're for talking about protecting your income when you're alive, of course you protect your income in death with the life insurance. Getting a good term insurance if you're in your 50s, 40s, 30s. We'll just have to kind of calculate what kind of income you need to replace, how many years you're trying to replace it. A lot of times, people are trying to replace the income until their children are able to take care of themselves or to give their spouses a set number of years to get themselves together and reposition their income or figure out what they're going to do. So that income protection is usually a type of life insurance that's when you for someone who passes away. But in life, income protection is more like a critical illness plan. If in case you get some type of chronic or chronic illness, like chronic or critical illness like heart attack, cancer, stroke, this will pay out a lump sum of money, maybe $25,000, $30,000 over a period of time, maybe 2 years, 3 years, or 5 years, that you put in place. So you pay a monthly fee and you put that in place, giving yourself time enough to either get healed so you can go back to work, or if you're going to end up being disabled for long term, give yourself time for the long term governmental assistance disability maybe to kick in. So that would be critical illness, chronic illness. And then the last piece, I saw someone had a question on long term care. So, yes, long term care is a little different from critical illness. Long term care is a plan that you put in place so that you can get some care either at a facility when you become maybe disabled and you can't take care of yourself. You may need to go to a nursing home, or it can be for someone to come into your home to take care of you. So you pay a monthly fee as well to get some a set amount of funds for services to pay for help to come into the home, or to pay for the needs at that time when you're can't really take care of yourself. So that would be long-term care. Okay. All right, guys, that's it for today. Today's goal was just to answer some questions from our seminar that we had last week. And those of you who have signed up for our future seminars, I'll look forward to seeing you in class. And hopefully we'll be able to go live with our class. Today we had a little bit of difficulty going live with our class, so hopefully those who were expecting to see us on live, that we will get this video out and everyone will get the answers to the questions. So therefore, if you are interested in reaching out to us, once again, you can reach out to us at waringfinancialservices.com. That's WARING Financial Services with an S.com. And it's our website. You can go up there and request some information or request a meeting or an appointment or a quote. All right, guys, thank you, and you all have a great day.